Welcome to this in-depth guide on building long-term wealth through growth-focused investing, specifically through the lens of the AOT Growth and Innovation ETF, AOTG. Today we'll explore a strategy that has delivered exceptional returns, up 91% all-time, 54% in 2023, 32% in 2024, and over 6% year-to-date in 2025, outpacing major ETFs like the S&P 500, VOO, NASDAQ 100, QQQ, Vanguard Growth, VUG, and Charles Schwab U.S. Large Cap Growth, SCHG. This approach prioritizes low marginal cost, high-growth companies that leverage share buybacks for tax efficiency, avoiding the high dividends and covered call strategies popular among retail investors. By focusing on profitable, large-cap technology and fintech firms, this strategy offers a repeatable path to outperform the market. We'll dive into its mechanics, benefits, risks, and practical steps for young investors to replicate it, all while emphasizing that this presentation is for entertainment purposes only and not financial advice. The foundation of this strategy stems from a deep understanding of economics, honed through studies at prestigious institutions and years of personal investing. Starting in high school, the portfolio manager experimented with real estate investment trusts, REITs, expecting steady dividends and growth due to population-driven housing demand. However, REITs like the Vanguard REIT ETF, VNQ, stagnated, with prices barely moving since 2011 and yielding only 3 to 4%. This led to a pivotal realization. Traditional dividend-paying assets such as REITs or oligopolies like Potash Corp, Anheuser-Busch or Boeing underperformed compared to technology giants like Microsoft, Apple, and Visa. These tech firms with minimal dividends but massive share buybacks delivered returns multiples higher than their dividend-focused counterparts. This insight sparked the creation of AOTG, the AOT Growth and Innovation ETF, launched 3 years ago to capitalize on low marginal cost companies, firms that produce additional units at near zero cost, enabling high profit margins and rapid earnings growth. With a portfolio up 91% all-time, including gains of over 1,000% on stocks like QCR Holdings and 500% on Apple, AOTG has outperformed benchmarks like VOO, up 15% annually, QQQ, VGT, XLK, and SCHG. The portfolio manager's journey began with personal investments for family, evolving into a professional role as an options market maker. This experience highlighted the limitations of covered calls, which generate income but sacrifice significant upside in bull markets. Instead, AOTG targets companies with high earnings growth, 80% plus annually versus the S&P 500's 4%, and low marginal costs, such as Microsoft, where selling software like Office incurs negligible additional costs, yielding profit margins near 100%. This contrasts with traditional firms like Ford or Boeing, where scaling requires costly factories, shrinking margins as sales grow. AOTG's portfolio is a concentrated bet on large-cap profitable companies with low marginal costs, primarily in technology and fintech. Holdings include Microsoft, Apple, Visa, Google, AMD, Robinhood, Toast, Workday, and Salesforce, with weights of 6 to 7% for smaller names like Robinhood and AMD to maximize growth. Unlike market cap-weighted ETFs like QQQ or VOO, AOTG actively selects stocks for their earnings growth, targeting 80 to 100% annually and reasonable valuations, for example, Robinhood at a price-to-sales ratio of 3. This results in a portfolio with a low dividend yield, around 3%, but high capital appreciation, driven by share buybacks and reinvested profits. The strategy avoids high dividend stocks and covered call ETFs, favoring share buybacks for their tax efficiency and ability to boost share prices. For example, Google's $100 billion buyback program creates a price floor during downturns, as the company repurchases shares at lower prices, while also increasing shareholders' ownership. If you own 10% of a company, buybacks might raise your stake to 12% over years, amplifying earnings per share, EPS growth. Google's 44% revenue growth in a recent year translated to 50% plus EPS growth due to buybacks, far outpacing dividend-focused firms like Coca-Cola, 2 to 3% EPS growth. The portfolio allocates a small portion to the S&P 500, VOO, as a safety net, though the manager regrets this due to its 15% annual return lagging AOTG's 30% plus compounded growth. Cash reserves in a money market fund, for example, BOX, provide liquidity for opportunistic buying during market dips, such as AOTG's low of $30 in April 2025, now at $52.05, up 73%. This lump sum approach contrasts with dollar cost averaging, DCA, as timing the market often leads to missed gains. For example, waiting for a 3% dip risks missing a 20% rally. Low marginal cost companies like Microsoft or Robinhood are the cornerstone of AOTG's outperformance. These firms produce goods or services, for example software, financial platforms, at near zero incremental cost, enabling high profit margins and scalable growth. For instance, Microsoft's Office subscription generates $100, $200 per user with minimal additional cost, unlike Ford, where a 10% sales increase requires nearly 10% higher production costs, yielding 1 to 2% margins. This dynamic allows tech firms to grow EPS at 80 to 200%. For example, AMD's 200% EPS growth in a recent quarter, compared to the S&P 500's 4%. These companies also innovate rapidly, reinvesting profits into new products or improvements without heavy capital expenditure. PayPal, with 2% revenue growth, achieved 44% EPS growth by leveraging low marginal costs and operational efficiency. In contrast, traditional firms like Boeing face scaling challenges, funding growth with debt that erodes margins. AOTG's focus on large-cap, profitable tech and fintech, for example Visa, Toast, minimizes risk while maximizing growth, avoiding unprofitable speculative stocks like CRISPR Therapeutics, which crashed 75% in 2022 due to zero revenue. Share buybacks enhance this strategy's appeal. Unlike dividends, which incur immediate taxes, up to 50% for high earners, buybacks defer taxes until shares are sold, often at lower long-term capital gains rates. A $1 million portfolio yielding 3% in dividends loses $15,000 annually to taxes, while buybacks keep that capital invested, potentially doubling to $2 million in 3 years at AOTG's 30% growth rate. Buybacks also create downside protection, as seen in Google's $100 billion program, which stabilizes prices during corrections. Covered call ETFs, popular among retail investors on platforms like X and Reddit, generate high yields, 30 to 80%, by selling call options on volatile assets like Tesla or Bitcoin. However, this strategy caps upside potential, a significant drawback in bull markets. For example, AOTG's 54% return in 2023 and 32% in 2024 would have been limited to 10 to 15% with covered calls, as sold options restrict gains when stocks surge. In a covered call ETF tracking the Nasdaq 100, the underlying index's 50% plus returns are often halved, with yields offset by NAV erosion, for example some funds down 70% all time. Covered calls make sense for retirees needing immediate income as they provide 10 to 15% annual cash flow to spend. However, for long-term investors, especially those under 50, capping upside sacrifices the compounding power of growth stocks. Selling short-dated calls, for example 1-month options, yields 1 to 2% but offers minimal downside protection, exposing investors to full losses in downturns. In contrast, AOTG's focus on uncapped growth allows investors to capture full rallies, as seen with Robinhood's 200% plus gains from a low price-to-sales ratio. The portfolio manager's experience as an options market maker reinforces this view. Covered calls, while useful for hedging specific positions, for example locking in gains on a stock up 50%, are inefficient for portfolios aiming for maximum returns. High yields often mask NAV erosion, where distributions include return of capital, reducing share value. AOTG avoids this, prioritizing capital appreciation and tax efficiency through buybacks, which defer taxes and enhance EPS growth. This strategy offers several advantages for long-term investors. Superior returns. AOTG's 91% all-time return, 30% plus annually, outpaces VOO's 15%, QQQ's 20%, and SCHG's 18%, driven by high EPS growth, 80% plus versus S&P 500's 4%. A $10,000 investment in AOTG 3 years ago would be $19,100, compared to $15,600 in VOO. Tax efficiency. Buybacks defer taxes, preserving capital for compounding. A $1 million portfolio with 3% dividends loses $15,000, $30,000 annually to taxes, while AOTG's buyback-focused holdings keep funds invested, potentially growing to $2.6 million in a decade at 10% growth. Downside protection. Large-cap tech firms with buybacks, for example Google, Microsoft, create price floors during corrections, as seen in 2022, when Google's $100 billion program limited declines. Scalability and innovation. Low marginal cost firms scale without heavy debt, reinvesting profits into innovation. Microsoft's cloud expansion or Robinhood's platform upgrades drive EPS growth without the capital constraints of traditional firms like Ford. Diversification across sectors. AOTG includes tech, Microsoft, AMD, Fintech, Visa, Robinhood, and SAS, Workday Salesforce, reducing sector-specific risk while capturing growth across innovative industries. Despite its strengths, growth investing carries risks. Technology stocks are more volatile than utilities, with potential 20 to 30% pullbacks in recessions, as seen in 2022. However, the portfolio manager views traditional firms, for example Exxon Boeing, as riskier due to their debt-heavy growth and shrinking margins in mature markets. AOTG mitigates volatility by focusing on profitable, large-cap firms, avoiding speculative names with high price-to-sales ratios, for example CRISPR's 100x in 2021. Another risk is market timing. Lump sum investing, as practiced by the manager, can lead to buying at peaks, though historical data from Vanguard shows timing the market, for example waiting for a 3% dip, often results in missing 10 to 20% rallies. AOTG's 73% gain from $30 to $52.05 in 2025 underscores the cost of waiting. To manage this, the portfolio holds cash reserves, for example Box X for buying dips, as executed in April 2025. In a recession or market crash, the strategy remains consistent. Buy more AOTG during dips to capitalize on lower valuations. The manager avoids shifting to defensive assets like utilities or dividend stocks, which face structural challenges in a declining demographic environment. Western Europe and Asia's falling populations reduce demand for traditional goods, for example Coca-Cola, water utilities, while tech and fintech benefit from global demand for automation and efficiency. The Blossom platform has been crucial for sharing this strategy, with the portfolio manager's 91% gain inspiring retail investors. Blossom's transparency allows users to see real-time performance, fostering trust and education. The community encourages learning from diverse strategies, though debates between growth and covered call investors can spark toxicity. The portfolio manager at 31 envisions a long-term commitment to growth investing, with no plans to shift to dividends or covered calls near retirement. By age 48, when their children reach college age, they aim to involve them in managing AOTG, passing on investment knowledge. A $1 million portfolio at 30% annual growth could reach $7.6 million by age 48, providing ample flexibility for family and philanthropy. For those inspired to build wealth through growth ETFs, here are actionable steps. Focus on low marginal cost companies. Invest in ETFs like AOTG, QQQ, or SCHG, targeting tech and fintech firms with 20% plus EPS growth. A $5,000 investment in AOTG at 30% annual growth could grow to $38,000 in 10 years. Prioritize tax efficiency. Choose funds with low dividends and high buybacks to defer taxes. A $10,000 investment in AOTG avoids $150 300 annual dividend taxes, compounding to $25,900 in 10 years at 10% growth. Use ETFs for diversification. ETFs like AOTG reduce risk compared to individual stocks, with lower expense ratios, for example 0.75% versus 1 to 2% for advisor-managed funds. Learn from mistakes. Avoid unprofitable companies with high valuations, for example 100x price to sales. Early mistakes included holding REITs in oligopolies like Potash Corp, which yielded 2 to 3% but stagnated, and unprofitable growth funds like RK, which lost 75% in 2022. Growth investing, particularly in low marginal cost companies, is a proven strategy for long-term wealth. AOTG's 91% return since inception reflects the power of targeting 80% plus EPS growth compared to the S&P 500's 4%. This approach thrives in a demographically challenged world, where population declines in Western Europe and Asia reduce demand for traditional goods, for example Coca-Cola utilities, but increase reliance on automation, software, and fintech. The strategy's tax efficiency, driven by buybacks, preserves capital for compounding, unlike dividends, which lose 30 to 50% to taxes. A $100,000 investment in AOTG could grow to $760,000 in 20 years at 10% growth, compared to $430,000 in a 3% dividend fund after taxes. The manager's motivation stems from a mentor's advice to focus on the future, investing in sectors like software, semiconductors, and fintech that benefit from automation and efficiency. This vision drives AOTG's strategy, expecting continued innovation as AI lowers software development costs, boosting profitability. For investors, the key is conviction in a repeatable strategy. AOTG's outperformance, 30% plus annually versus S&P 500's 15%, reflects a disciplined focus on profitable growth, avoiding the pitfalls of market timing or chasing dividends. By staying invested through pullbacks and leveraging ETFs' tax efficiency, investors can achieve significant account value growth, funding dreams like travel, family support, or philanthropy. A growth-focused strategy with ETFs like AOTG offers young investors a powerful path to wealth, leveraging low marginal cost companies, share buybacks, and tax efficiency. With 91% all-time returns, AOTG demonstrates the potential to outpace the S&P 500, NASDAQ 100, and other growth funds. By avoiding dividends and covered calls, investors capture uncapped upside, compounding capital faster than income-focused strategies. Join platforms like Blossom to learn from high-performing portfolios, start with ETFs for diversification, and invest early to maximize growth. Thank you for exploring this guide to growth investing. Keep learning, stay disciplined, and take control of your financial future.